Hello, my friend, and welcome to my course, Investor Reprogramming. How to think, calculate, and earn like a professional. And ideally, right about here, I should give you some golden words of wisdom to make you want to watch the course to the end. Let me try to go about it the other way. What happens if you don't watch this course to the end? Well, most likely, if you received this video, if you opened it, then in all probability, you don't have stable results right now. Yes, you're trying. Yes, something's working out, but most often it happens during a trend. As soon as the market correction begins, you go back to your old results or even into the red. You lose some profit, and well, basically, you're not happy with the results. And you won't believe it, but in my 15 years on the market and over 8 years working with clients, when they come to me and talk about their problems, that something isn't working out, they can actually be grouped into just a few categories. And if we talk about specific tools, algorithms, which is probably what you're expecting, how to enter a trade, where to exit, where to take profits, and you basically think that's where the secret is. Most people think the same way. But the main mistakes I find in clients aren't related to that at all. And believe me, there's enough information in the world right now in English that answers all the necessary questions regarding tools, setups, and so on. So in this video, I'll tell you what I've learned over 15 years. Key mistakes, key false expectations of the market that led to losses. Yeah, I've lost money, lost it more than once, and thankfully I've moved past that stage. Thankfully, I found the reasons how to go through a transformation and what to give clients so they can earn too. So if you don't watch this video to the end, then my friend, you'll just stay right where you are. There really isn't any advertising in this video to sell you something or to tell you how great I am compared to other analysts. No. This will just be my experience regarding the market, what needs to be done, in what order, and how to define your path so that you can earn. So, if that's what you came for, find the time, make some tea or coffee, grab some snacks, and watch this video from start to finish in one sitting. I'm intentionally recording this video all at once, in one take, without any edits. It's not the first time I failed, meaning I have to re-record, but I want to convey the information gathered here with the same emotion and passion, and it really is very important. So please be patient and find the time. If your time is limited right now, just pick another moment and then start watching. And as for us, let's get started. So, who was this course actually created for? And who can it help? Now, if you really want to understand how professional trading works, what it means to earn month after month and to close every year in the black, and what, strictly speaking, is the holy grail and the secret of this whole system. If you don't fully understand how to control risks, how to calculate volumes, what lot size to use for trades, if you, despite the fact that you've seemingly figured it out, still don't understand which strategy to settle on, I will help you do that. And if you need your own individual plan free of charge without any payment in order to reach a stable profit and follow it, then this course is for you. Moreover, at the end of this course, I'll invite you to join the workshop for 60 days. This is a free workshop that I run for my subscribers where you can practically apply all the knowledge gained here together with me. Not with some random person, not for money, but together with me, walk this path and you'll see that it really works. So, I want to start our conversation with three key problems. Of investors, traders, call them whatever you want, but they're common to everyone. The first one is the lack of a system. And there's a good saying that goes like this: the longer we trade in the market, the more, actually, we begin to understand how important discipline is. And then there's the presence of chaotic trades. You found a signal in one channel, heard something, saw some news, and decided to enter. Essentially, in most cases, it's a random result, regardless of whether you made money or lost it. But when you don't have a system, you have no understanding of what went wrong or what, accordingly, needs to be repeated time and again. And that is what a system is. You won't believe it, my friend, but a system, in my case, is a story where day after day I perform the same actions. I wake up, analyze the market, make a trading plan for the day, and monitor specific assets, not 50, not 100. In advance, before the Moscow exchange session opens, I've looked at everything I need, and actually I'm monitoring those assets. The same applies to crypto and the American market. Everything works the same everywhere. The second problem lies in the risks. I'll put it this way. If we're trading in the market, very often we have the temptation to make one of the trades, well, let's call it in quotes, our favorite. And this favorite trade, you want to put a little more money into it, enter with a larger lot size because damn, well, it's 100%. It'll definitely make us money. And in most cases, all calculations are done by eye. Accordingly, if we look at the statistics over time, and I think it's very easy to imagine in your head, just imagine that you have 50-50 profitable and losing trades. Now, many beginners think that this is a problem. Actually, it's not. When you earn even just a little bit more on profitable trades than on losing ones, you're already in the black. But for this, we must always have correctly calculated risks. One trade can, and remember your own experience, one incorrectly opened trade can eat up our profit for a month, two, or three. And then it starts to haunt us, starts to drive us into depression. Accordingly, this concerns risks, and believe me, absolutely everyone had this problem, and I did too. The third problem is not understanding actually where to look for it. It's one of the most difficult because we tend to always justify ourselves. We tend to think that we're doing everything absolutely right. But in reality, only someone nearby, usually called a mentor, well, can find it very easily. That's why this course was created, so you don't go in circles for years, but to specifically and accurately point out where your mistakes might be. So you can look closely at your trading, find it, fix it, that is, fine tune it, and start earning. So that's the logic behind it. And imagine that, actually, all these three existing problems are supplemented by the illusion of quick money. Unfortunately, many, as a simple format, probably since 2020 or 2022, when investing became popular, when opening a T Bank account took literally a minute, as a result, the illusion of quick money returned to people. It used to be there in my day, back in 2012 or 13 on forex, when people thought they'd make millions. Now it's actually back, with people thinking they can do the same thing in the stock market. Alas, months and years can be spent trying to find that magic button, and not everyone finds it. Not everyone finds it, not because it's some super complex field, but because they're stuck and going in the same circle. Accordingly, the first thing I want to tell you is that there's no quick money here. It's a routine, it's daily work, and only in this case do you get a stable result. If up to this point, everything you've heard, you understand that, okay, it really is like that, and you accept it, we'll continue. In this case, I'll be able to help you. Because all these problems I've listed lead to the same thing. In my experience, there are several ways things can play out. The first is beginners who came to the market and got lucky. They jumped on a trend, say 2023 in the Russian market, or crypto, say 2024 or 25, if they didn't trade alts. And so basically, there are many such examples. He entered a bull market, made some money, and even later, if he lost and went back to his initial capital, he's already hooked on that profit like an addict and knows money can be made there. Right. And then if he hasn't done anything, he starts losing them. The second category, those who started losing money from the get-go, they might at some point, especially older folks. I have many clients 40 plus. Well, they basically just quit. A state of apathy, thinking the market is like a lottery or a casino and you can't earn here. So they just give up on it and leave. The third group is, how should I put it? I'd probably call them thrill seekers. These are people who love the rush. They come for the adrenaline. They love it when a single trade can swing their deposit plus 20 or minus 20%. That's totally normal for them. They're gambling, and if they lose, they just deposit more, like in a casino, and play again. To avoid these problems, we need to understand where they're rooted, meaning in which parts of our trading, and set a plan for what to do so that you personally, using this video's guide, can work through it all. So, who am I? Let's get acquainted. My name's Dmitry Abramenko. I do technical analysis. I don't specialize in fundamentals. I don't really believe in them, though I don't deny their ability to spot promising assets. But technical analysis is plenty for me to earn and help traders and investors achieve steady profits in any financial market. I started out with with forex. Again, as I said, 2012, 2011, 13. The Russian market, the American market, crypto, I've seen it all. I saw COVID, I saw peak oil prices, and the Russian economy growing like crazy. I saw the special military operation and its fallout, but it always amuses me when people say something happened in the market and they lost money, even though it happens all the time everywhere. If you think other markets are different, that's not true. If you're interested, look at the history of the US market when cannabis companies, or marijuana to put it simply, were allowed to go public. They'd grow 800% in 6 months to a year, then just crash to zero. It's the same kind of hype that happens everywhere, year after year in different segments. You might not notice them, but the financial world is the same. And my job is to use charts to get good results by finding these, let's say, anomalies you can profit from, meaning technical patterns. I work with investors and traders who are ready to change their trading starting today. So I have working methods, I have psychological, let's say, techniques, right, that help. But the key point that I always stick to, and I say this right away before we start working, is that this is work. Well, imagine you're starting a business. Yeah, so it's clear there's an option where you can build a company from scratch and even make money. Well, it's the same thing here. And at the same time, there are many different instructions and people who have already built a business. So I'm one of those businessmen who have already built their business and help or can tell you exactly where the mistake is so you can overcome it. As for my interest at the moment, for this year, it's the Russian American market, the derivatives commodity market, meaning futures. It's forex and it's cryptocurrency. If you're wondering where to trade America, well, if you're in the workshop, I'll definitely tell you. There's still an option that's completely safe and legal for Russian citizens. You'll be able to trade at any time. As for achievements, everyone loves them. Let me give you a brief overview in case you haven't been to my site and don't know what it is. And basically, if you're hearing me for the first time, well, a qualified investor, can be achieved in different ways. Either it's an FSFR certificate, as it used to be called, or it's account turnover, and I've had it since 2012. I currently have my own system for automatically calculating fixed risk with clients. So absolutely every one of my clients gets the volume they need to open in a trade based on their own deposit specified in the settings. And in this video, I'll tell you the formula for how to make one exactly like it for yourself. I'm the author of the only program on Andrew's pitchfork and shift in Russia. Maybe you don't even know what that is, but if you're in the workshop, you'll definitely find out. It's a very cool tool. It works like a charm. It gives 82% profitable trades, just like that, in any market. Online in 2019, I earned 22.4% in 25 days. Actually, there was this thing, I don't know why, but I had this idea that as analysts and mentors, we should periodically prove our experience and qualifications. So I held marathons. And so in 2019, it was a marathon where for a 500 ruble entry fee, I invited about 20 people and said that within a certain period, we could make money. So in 25 days, we made 22.5%. Then in 2021, I held a public marathon. There. We also took participants. There were 20 participants. I put the collective money into FineArm and showed everyone online. So they were trading along with me. The condition was that we earn at least 20% in 90 days. We finished in 87, and all those verified results are still saved today. Many clients have been working with me for many, many years. And probably the key peak moment was in 2023 when I decided to simplify things. I ran a completely free marathon on my channel for 18,000 subscribers, giving out all the info, where to enter, how to manage trades. I explained everything, showed it, commented on it, and calculated the volume for them. I calculated for 1 million, and then the subscriber could recalculate for themselves how much they needed to open so that our results would definitely match in the end. So in 30 days, we made almost 27%, just about, which I consider to be a pretty good achievement. Because all these certificates and diplomas, you can talk about them and statements can be fake too. But the best results, in my opinion, is the result of the people who are walking this path with you. Accordingly, my business in terms of working with clients is based on one very simple thing. If the clients make money, I make money. If I make money, it means my clients are making money. We work together, we're in the same boat, and so I'm inviting you into this boat right now. As for the results, if you need to, you can pause. I'll scroll through slowly, bit by bit, so you can see from the number of reviews and the dates on the Telegram screenshots that we've been working for a very long time and we have tons of results. 2023, 22, 21, 20. Since 2021, I've been keeping public statistics of my own reports, meaning my trading account and my clients' accounts, those who share their reviews and results. And so at this point, there are over 250 of us working together and basically trading in all markets. Everyone's satisfied, everyone's happy. And most importantly, yes, they are earning consistently. And you can earn consistently too, simply by repeating the same steps that I took back in the day. And again, I'll say this isn't about advertising at all. I just told you about myself and what I do, so it's easier for you to understand the extensive background I have behind me. So, the time you've set aside and that you'll need for this video is necessary to change your trading forever. Believe me, the tools, especially say things like risk management or the system we're going to build, can change things and never let you lose your own funds again, no matter what market you're working in. Even if it's crypto, even if a 20 to 30% drop happens, the tricks I'm going to share work absolutely every time. The key questions we're going to look at, there are only 5 of them, so essentially they could probably be split into 5 lessons, but I don't believe in that. I've tried many times to do public marathons, teaching people for free, telling people what they need to do, but I ran into a snag where after the first lesson, people take a break, saying they'll definitely find time later. So now, this is just one video, even though it consists of 5 different parts. And this is so that you can go through everything in one style and one mood and immediately start using it. The first topic is the 2 levers that turn your account around and why 97% of investors ignore them. 2 tools with which you can start earning as early as tomorrow, and for some reason, many perceive them in the wrong way. Yes, my task is to show objectively what these levers are, how to use them, and what to pay attention to, so that if necessary, if you need money, if you came to the market for money, you can raise it immediately. The second topic is the profit acceleration formula, how to earn 3 times more without unnecessary risk. Accordingly, how you can use leverage, how to correctly calculate risks, what this acceleration formula consists of, that is, what you need to focus on in your trading with specific examples. The third topic is how to calculate risks. This is a ready-made algorithm, my own, which I use every day in all markets. Well, actually, now it's all automated through Telegram bots and on my website, but nevertheless, you will need the formula itself, so you can even do it in your head. Fourth is the precise entry technique. I'll tell you how to use orders correctly so that you forever forget about slippage, about entering at the wrong price, or exiting if you're closing a trade. This is a very important point. According to my statistics, probably 10 to 15% of the annual result, imagine that, the annual result is lost precisely on incorrect orders. For example, you earned 85% a year instead of 100 just because you pressed the wrong buttons. And here's the fifth. We'll create a roadmap for the next 90 days so that you can clearly and transparently know where to go, what to look at, and what to do in order to actually start repeating good results instead of negative ones. As a result, you will have specific tools for market assessment. That is, when to trade most profitably, you'll clearly understand. These are very simple tools. Second, you will have an algorithm for calculating fixed risk. That is, for any instrument, for any market, you'll be able to calculate very quickly. Third, you will have instructions for your broker. I will add these as separate files after the video. That is, I'll explain the basic principles and accordingly, you can choose the instructions you need for your broker. If there are several, you'll take several. And fourth, you'll have a roadmap, that is, specific steps that need to be used. This is a small introduction that is required so that you understand what we will be doing. Because the video, one way or another, is not like standard 5-minute advertising clips. And, well, it's probably not created for the general public. I understand that perfectly. And I'll probably understand if you don't listen to it until the end. Unfortunately, that happens too. We are started. Lesson 1, Part 1, the two levers that specifically turn your account around, and for some reason, 97% of all investors and traders ignore them. So let's talk about the standard path of an investor, how it usually happens, or how it happened for me and for most of my clients. The idea to invest comes to mind. Someone told you about it, mentioned the interest rates and the money you could make. You found a broker, like the example I gave, right? You open some T-Bank app on your phone, quickly open an account, and basically that's it. You're in the market. And if you're lucky, you entered the market during a period of active growth. I've already given an example like that. You managed to make some money, the trend ended, and you start losing. First the profits, and if you're unlucky, then you start losing your own money. But if you were unlucky from the start, then you begin losing your money right away. And in the best case scenario, looking back, you see zero results and realize how much time you've wasted. And my friend, this is a common story. There is no other. It doesn't exist. No need to think otherwise. Here, maybe this is how it should be said. For a very long time, I believed that in many matters, I was some kind of individual, a unique personality. But life shows over the years, the older we get, the more I realize that in many matters, we are just a gray mass that acts the same way. To help you understand how big of a problem this is, the entire stock, crypto, and forex markets, basically all financial markets, are built on psychology, the psychology of human behavior. Human behavior psychology hasn't changed in the last 200 years, since the inception of the stock exchange. Given this, technical models were devised that reflect this behavior. Accordingly, technical analysis, which is prioritized abroad and is the #1 tool for analysis on the English-speaking internet, even though for some reason here in Russia, fundamental analysis is considered better. So technical analysis actually reflects how and what pattern people behave and what that leads to. In other words, it's just basic logic. And so, despite the fact that it seems to us that we have a different path, it'll still be the same until we fix this whole situation. And at the moment when you finally realize that the old approach is no longer capable of making you money, you fall into one of two categories. Some start looking for ready-made signals. I won't call them free riders. No, there are plenty of busy people, businessmen, managers, I don't know. If you're a family man and you have almost no free time, you might just need ready-made ideas, signals, to make money right here and now. The second category consists of people who commit themselves to the market and they realize that they want to do this on a permanent basis. It so happened for me that I was very young when I first encountered the market, and I was so captivated by the subject that I saw myself as someone who earns a living from it. Meaning that's all he does, and it inspired me to such an extent that at the present moment, basically, I don't know any other field at all. Yeah, so if you are in one of these categories, maybe you should start learning. But it's important to understand that both are absolutely normal. And again, there is no third way. So there are two situations that you need to overcome to get through. So I have no intention of exaggerating or deceiving you. I'm just sharing examples I've come across during my work with clients who decided to make money. With me, without me, just generally, those that I've encountered along the way. And both of these approaches are actually real. So if you feel like you just want to find a ready-made place where they give, I don't know, signals, information on what to buy, please, that's also a viable path. I mean, there are just nuances that 97% of all investors ignore. And that's what I want to talk to you about right now. If we look closely at what a trade is, it consists of three parts. what to buy, at what price, and where exactly to exit. This is the very information that most investors need. Whether you get it for free or pay for it, you expect to make money on it, and if you're lucky, more than once. Well, I mean, you start to trust this person. It saves you time, but there's an important nuance here. Your result as a client almost always differs from the result of the idea. What? Because they simply didn't tell you what volume they entered with. You didn't enter at the moment you were told to. You have different brokers. What does that mean? It means you set a limit order. For example, let's say one broker filled it at your price, but another had slippage. And in the end, you got a different result because the entry point was different. You might have a different risk profile, meaning one person risks 1% on a trade while another risks a different amount. And this is where a very interesting moment occurs. Imagine a situation where, let's say, I give you 5 trades, and out of those, 3 are profitable and 2 are losing trades. Well, that's roughly 65% profitable trades. Overall, it's not a bad result, so you can end up in the green after this series of trades. But now, imagine you didn't enter the profitable ones because they were first and you didn't trust me yet, so you just dipped your toe in, but you went all in on the losing ones and you end up in the red. And in the end, you start thinking that, well, maybe I'm a bad analyst. And to avoid this problem, you need to have more information. And not everyone understands what this more actually means. So, what's missing from this scheme? First is the risk calculation. So, we need to enter with the same volume so that when I say at the end that I made this much from the trade, you can check your account on your phone or laptop and see for yourself. Damn, yeah, I made exactly the same amount. And the second point is where the cancellation level is. So, look, for example, I have a Telegram channel, and everyone writes to me there, Dimitri, give us some trade, give us a signal. I get it. And it just so happened, or that's just how life works, that, well, I was asked for free, so I shared it. So a week goes by, and it turns out that someone lost money on this trade, meaning the scenario didn't reach the end, it was some distance from the target, or let's say, take a bad scenario, it went the wrong way almost from the start. And I canceled this trade or didn't enter it at all because it didn't go according to plan. But other participants entered and decided to wait it out. So the information on where the cancellation of our trade is, including one that's already open, should also be present. And almost everyone underestimates this information. Risk can't be calculated without understanding the cancellation level, that is, the stop. And accordingly, a stop must always be present. And in 99% of free channels, this information's never given. I don't give it either. Why? Well, because, well, I have no responsibility to these people. And I don't know anyone anything. Well, buddy, sorry, but that's just how the market works, and you just have to accept it. Accordingly, there are issues with paid services too, which also don't provide that kind of information. In other words, they don't give you the lot size based on your deposit. So he said roughly what percentage he took from his own account. That's the best option you can get. They don't talk about their risk percentage. They don't say what kind of acceptable loss they're talking about in a specific trade, which means in the end, everyone gets a different result. If we come to the market, let me say it again, let's draw an analogy, maybe with business. Let's say I have a shop, maybe a coffee shop, and I make coffee. I need to buy coffee beans from my supplier. I place the order, he delivers it, and in the end, the price is different. He told me one price, but in the end, he charged me differently or brought a different amount. So it's a pretty similar situation. And in my understanding, trading in the financial market, if we've decided to make money in this market, and especially if we're taking responsibility for someone else, we need to do it properly. Everything should be transparent and known in advance to absolutely everyone, including you if you're opening this trade on someone else's behalf. Accordingly, if you enter with the same instrument but with a different position size, without calculating risk, with a different stop, or you hold on too long, your statistics will never match the signal source. And no matter how much you want it, Murphy's Law says that the most unprofitable trades usually go to the person who likes to pick and choose. Like, I'll trade this, but I won't trade that. And basically, this is the key reason why beginners lose their deposits when they try to copy successful analysts. So, this is the point I want you to understand. There are actually a lot more successful people trading in the market than you might think. But let's say a poor approach to organizing services, a poor approach to working with clients, and a lack of interest in their results, as opposed to just focusing on your own commercial success and collecting money, this all affects the outcome. And it's dangerous because you end up losing your own hard earned money. And so, in part three, to help fix this problem, I'll give you my ready made risk calculation formulas so you can use them and never again find yourself in a situation where you don't know what position size to enter with and just end up guessing. Ideally, if you do end up finding a service, that is, if you're looking for a service with ready made information, let me repeat, you don't have time, you don't want to learn, or at least you realize that for now you'll use something ready made and pick up the learning part later once you've gotten the hang of it. So you need the full set of information, including the stop, that is, when to exit in advance if something goes wrong, and the position size for each trade you need to enter, meaning the amount to enter a specific trading position. Just these two elements, added to the algorithm, to the copy trading service itself, will help you achieve the results of the source you're working with, or get as close as possible if there's some margin of error. Maybe you didn't enter at the exact moment, didn't exit at the right time, or there were some minor slippages. And then from the number you filtered by having all this information, you just need to pick the best source. There are only a few criteria here, and I suspect you already know them too. That's having access to the trades so you can check them, meaning if needed, you can look at one or another trade on the chart. It's the ability to contact the service's clients, which is a very important point. Almost no one offers this. I realized this trick probably 3 or 4 years ago, and it's actually very simple. And the clients who work with me, if they like it, they'll gladly tell you about me and my service, what it's like on the inside. So if you're not given this opportunity, most likely there probably aren't any such clients. Either there are no clients at all, or there are no clients willing to vouch for the service. Or maybe the person is just worried that people might say something that, well, let's put it mildly, can't be controlled by the admin. And accordingly, we are talking about resolves. That is, what kind of results are achieved over time? In my case, I have results that I've been showing since 2018. Year after year, the statistics are available so you can see both the trends over time and the specifics for individual months. I don't hide drawdowns, I don't hide losing trades, but this gives people transparency before they start working with me. I'm saying this so that when you look for another service, when you need ready made information, please make sure you do it the right way. Don't waste your money and know that, yes, these services can make you money if you choose the right one. So all you have to do is make the right choice. The key performance indicator for a service is the average profitable trade. The overall result that is earned, say over a month, 6 months, or a year. In other words, it's best to look at a longer period, like 300 to 500 trades, and then evaluate, meaning the overall result, the total number of trades, and you'll get the average profit. Next, you need to figure out or find out about how many trades are made per month. So you multiply the average profit per trade by the number of trades per month, and more or less, you get the result you can expect from this service. Next, you compare the cost of the service, your deposit, and the result you'll get, and you have a clear objective answer. In other words, it should be exactly the same kind of investment, where the whole idea of the service is that you only share a small portion of your profit. Not half of your profit, not all of it, but just a small part of your profit is shared with the creator of this service so that they can help you earn even more. If this condition is met, I suspect you'll be using this service for years. So let's look at the second path. You don't need signals, you don't need ready made information, you know exactly what you're doing, you're awesome, and you want to build your own strategy. That's also an option, and a pretty good one, but you need to understand what independent trading actually involves. So, everything we've discussed, risk calculation, what to buy, what price, where to cancel, where to exit, two more elements are added: what to change and where the mistake is. In other words, a system can't be created in just one day. And most importantly, its tweaking and modification never really end. No matter how long I've been working, I always realize that I might encounter something new tomorrow, or something might happen, and I'll need to make some adjustments. And you can only understand these things if you analyze your own system. Let me give you a simple example before we move on. The logic is this. Let's take a simple book. I have a lot of books, for example, on technical analysis. Let's take any of them. Let's pick some ready made book based model. Don't be quick to say that it doesn't work. Some don't work and some do, but not in every situation. And your job is to figure out in which situations it doesn't work. First, go through the history, again, the same 300 to 500 trades, take notes, then tweak, modify, implement, and move on to the real market. And when you see your own results and analyze them, if something isn't working, you start making adjustments. And here we come back to the same point I mentioned at the very beginning. This is routine work. In other words, when you get to a system that works, my friend, it doesn't give me any emotions. Every day I just come to the market. Every day I just look at the charts. The only thing that gives me any emotion, frankly, is the money I make and invest in something else. Into my emotions, into travel or shopping or family or something else. So it's this part that brings emotions, not, as I originally thought, that this is some kind of cool, I don't know, area of life or job that's interesting in itself. So, in order to analyze your results, you'll need an investor's journal. Trader's diary, trader's journal, there are many different terms, but the most important thing is that we record information in it: why we entered, why we exited, what went according to plan, and what didn't. And by recording all the necessary information, start with at least 50 to 100 trades. You'll be able to analyze your trading, eliminate the weak points in your system, strengthen the effective ones, and stabilize your profits. You'll even be able to see from this journal where you messed up and didn't follow your system, exited at the wrong time, entered at the wrong time. So, what counts as part of the system? Let's be honest here. If you find a trade in your journal that cost you half your profits over several months, and when you read the description, it says you bought on the news or trusted some channel, that's not a system. You just believed in something. That's emotion. That's some other part that has nothing to do with the system. What does your system have to do with it? So you throw out all those trades and only look at the ones where you traded correctly. And that's how a journal helps you figure out what's going wrong. The algorithm for building a system is shown on your chart, that is, on your slide. This is the simplest way to reach an independent level of trading. How fast you progress depends on your effort and how correctly you approach each stage. In practice, I know that with ready-made tools and all the necessary algorithms, you can achieve results in about 4 to 6 months on average. That is, from zero when you didn't understand anything to the point where you find trades yourself and make money from it. But once again, think about it. The independent path means you'll have to get each of these algorithms for yourself. Somewhere, maybe you'll find a ready-made one for free somewhere. I don't know, maybe you'll find some course on a torrent or a leaked site and it turns out to be effective. You'll have to tweak something, come up with something on your own. In this path, if we're moving forward on our own, I'm not going to lie to you, it can take years. It took me probably 3 or 4 years, but unfortunately, I didn't have anyone to help me. At the end of my journey, in the third or fourth year, I finally got a mentor who helped me see the key thing I was missing. So it happened in a roundabout way, but still, it happened. And well, in the end, there's really no magic in trading. Depending on the way you choose to make money, one way or another, you'll have to go through everything I've described. So at the end of the video, I'll show you a roadmap for the independent path, how you can achieve stable earnings this way. And I'll give you the chance to join our workshop where I'll demonstrate this with real examples from the current market so you can see for yourself that, damn, technical analysis works. It's awesome, and you can actually make money from it. The main thing is to follow all our steps in a certain order. So, is it worth paying money? That's probably the question running through your head. Why is he even talking about this? It's actually very simple. One way or another, we're all circling around this topic. There are tons of services, tons of free information, and some people are trying to lure you in for a fee. Let's not run away from this. Let's just draw a clear line. We've already separated the signals with you. That is, what's important inside and what might actually be worth paying for. We've talked about learning, and here are the algorithms that, in theory, you should be getting. So, to sum it up, I want to lay out the criteria for paid and free options and how they should differ. In other words, so you don't end up paying 50, 100, or even 200,000 rubles for yet another course or for signals and then getting no enjoyment out of it and make no money. Let me repeat that one more time. A small portion, it's like a commission, like a tithe that you pay your mentor because you've earned more. He should be earning more than you. So, any paid service or training should speed up your path to consistent profits. In other words, the amount you pay should bring you even more money in return. And there should be clear benefits. Without them, a paid service is just money thrown away. First, if you buy mentorship or signals, the cost of the service should be significantly less than your projected profit over the next 12 months. Second, the service should save you time. That means you get ready made analytics. You're not the one sitting there analyzing charts. Someone does it for you and clearly shows you where and how you might enter a trade. Second, it's about specific trades with all the parameters provided. They've done the calculations for you. All you have to do is use this information and simply repeat it with your own account, since you're not giving anyone access to it. And third, it's the ability to get quick feedback. Come on, there's always a situation where something isn't clear. So there should be a real person assigned to you. Not AI, not a robot, not a chatbot, but a real person you can message, call if needed, and who will help you out. From my own experience, I know that when clients start using the service, some of them don't know how to place orders. Some have never traded futures and think it's scary. Some have never traded with leverage and think it's scary. So it's important to give people the right information so they can see everything they need and only then make a decision. And only a real person can do that. That's why I assign a dedicated person to each client, someone they can call, someone they can message, and get all the information they need. In this case, I believe, yes, we do charge money because the service allows you to fill in all your gaps and keep living your life as usual, but with the added bonus of earning thanks to this very service. If we're talking about training, then the program should contain specific algorithms without any subjectivity or references to prior experience. Let me give you an example. If we're talking about some setup or algorithm, it should be structured in such a way that neither you nor I, after reading this information, are left with any ambiguity about whether it should be done one way or another. If something's misunderstood, it should immediately be worked through with practice and assignments. In other words, you need to eliminate the possibility that you absorb the knowledge incorrectly. And for that, you should have a mentor and a supervisor. Without feedback, learning's impossible, my friend. This isn't the kind of field where you just watch a YouTube video and basically learn how to trade. Who am I even telling this to? I'm sure you've watched some other video, someone showed you something, you tried it, and then something went wrong. So, if we're talking about paid training, the algorithms need to be ready. They should be so structured and systematized that if you just repeat them, you make money. If that's not the case, run. It's not real training. It's just a parody that they're charging money for. Basically, just a business scheme. And yes, my friend, paid signals and training really can boost your results. If you get access to complete and accurate information that can't be interpreted any other way, where you can't blame it on misunderstanding, entering with the wrong amount, or using it incorrectly, you will make money. That's a fact. And unfortunately, a lot of people ignore this opportunity, blaming it again on info gypsies, scammers, or someone else. But in doing so, they close the door on a way to quickly achieve results. So let's quickly sum it up. The first lesson. We talked about two trading methods that, whether we like it or not, work and will continue to work at all times in any market. Russian, American, and the Russian speaking internet or abroad. These services exist everywhere, they work everywhere, and people make money with them. The specifics of choosing the right sources for ideas and signals, as well as the reasons why results may differ. Don't forget about volumes and how to enter a trade, where to exit. You should always know this even before you enter. The specifics of the path to independent trading and the two most important stages that honestly most people never actually do. When I conduct surveys and gather statistics, it turns out that most people don't even know what a trading journal is. Well, let's not kid ourselves. Chances are you don't know either, or at least you don't use one. A broker's report, look, that's not a trading journal. We need the reasons why someone entered and exited a trade, and almost nobody does this. And here's where you see the paradox I was trying to explain to you in the first part. We want to trade independently. We don't want to pay anyone. We want to get there ourselves. But we don't do anything to actually make it happen. We don't analyze, we don't refine, we just jump from one server to another, from one service or channel to another, gathering information and trying to trade. And the main thing is, as time goes by, our results don't match up. In other words, we don't get what we want, but we keep doing the same thing. So, to do things right, I hope you understand now. So, if you decide to pay for signals or for training, what should be included so that it's not just about a good price, but so that it actually makes you money? No more, no less, and no emotions. Let me repeat, I'm not trying to advertise anyone in particular. Lesson number two. If you've finished your tea or coffee, you can pause and come back later. But I'll keep going. Part two. This is the formula for accelerating profits, or how to earn 3 times more without extra risk. What do we have here? The stages of a trading deal. Let's take another look at our topic. We've already said that a trade consists of 5 stages. And a strong trend, most of these stages almost stop mattering for a beginner. What does that mean? You might have calculated your risks wrong, entered at the wrong price, not known where your stop is, and the market would just push you back out. And, as they say, the trend forgives mistakes. That's why it's easier for you to trade, and in this part of the market, you make money. But after a while, even if you made a mistake, the market keeps trending, keeps moving, and your trade ends up in profit. That's basically why it's easier. In a trend, the market forgives everything except one thing. You have to exit on time when it ends. That's the only step you can't skip. It's better to exit a little early than to wait too long and get caught in a correction. Because then a whole series of psychological problems starts like, wait, it's just a correction, it'll be fine. So once again, I want to remind you that in 2023, there was a marathon. Just imagine, in a month, we made almost 30%. I gave it to people for free. I have tons of reviews, screenshots, people thanking me. Everything was great. Dimitri, awesome, thank you. We did it all. A month after our marathon, I was still sharing some information on the rating, just like it usually happens on Telegram. And then, after a month or two, a correction starts. Sometime later, I did a survey to see how things were going, and it turned out that people stayed in their positions. They didn't close them. Some were breaking even, and some were in the red. At the end of 2023, we started comparing results. Most of our clients had a little over 100%, confirmed by their screenshots, because they were told exactly when to exit. But the subscribers didn't have that. Some of them even closed with a loss. So we come to the conclusion that, damn, even having ready-made information in a signal isn't enough for a person to make a profit because they don't know when to exit. They don't have a system. They don't have an algorithm for how to do it. And so basically that's the story here. I'll just fast forward, but that's exactly how it all happened. So here's the marathon. Here's a screenshot showing how it all went down. We made money. And for most people, this was actually the fastest profit they'd ever made in their lives. They'd never earned that much before. Many thought like, damn, this is impossible. This is just some info guru talk, you know? After some time, here you go. Here's the stats. Take a look at the slide. 20% ended the year in the red. How's that possible if we made 20 in just a month? So, in the end, the marathon just got tossed aside, and that's it. Nobody needed it, and no one learned anything from it. People got used to thinking it's enough to just buy without a stop loss, and the market will pull it up later. And there are tons of stories like this. Let me say it again, okay? Crypto, Bitcoin, it's not the first time it's gone up and then crashed. How many millionaires do we have now? Good for you if you know someone. I don't know anyone in my close circle who just became one out of nowhere. The trend in metals, the trend in Russian stocks, that was one thing when the special military operation started. The trend in Russian stocks after COVID in 2020. This story just keeps repeating itself. Every time, as investors, we wait for something new, but nothing new ever happens. When the market is in a correction, it doesn't forgive anyone and takes everything back. That's why there are three phases of the market that always repeat. Those are the trend, the sideways movement, and the correction. Well, I guess this isn't new information for you. So, in a trend, a beginner can make money even if they don't fully understand what they're doing. But in a sideways market or during a correction, all five elements of a trade that we talked about become important. That is, how to choose an asset, where to enter, where to set a stop, how to calculate risk, and how to manage the trade. If they don't know this, they lose money. That's why the difference isn't just in the approaches, but in the market itself. In other words, think about it. We're not talking about some specific magic tool that I just handed over to you and now you're making money. I'm trying to get across the idea that there's a market phase where it will be very hard for you to make money without a system. So maybe it's better to just skip that phase. But we'll talk more about that later. So investors often believe that it's enough to just buy a quality asset and wait for it to go up. But after the start of the special military operation, the Russian market completely shattered that illusion. No system, no protection, buy and hold just doesn't work. If you look over a 20-year span, there are actually very few assets on the Russian market that can deliver significant profits. And now we're getting to the concept of the ideal market. An ideal market is a directional movement, a chosen sector within a group of assets, maybe in a hectare, I don't know, over a certain period of time. The metals trend, cryptocurrency, the traditional holiday rallies in the US, IT companies, the e sector, cannabis, I told you about that, right? These are all examples of what you'd call an ideal market. From my observations, based on the statistics from my service, where we work with clients, about 20% of the time accounts for up to 80% of the year's results. So, roughly speaking, throughout the whole year, we're trading, and on average, let's say it's plus or minus 5% per month. Some months it's 5%, some months minus 5%, sometimes zero, sometimes plus 3%. So, if you average it out, we get about 3 to 5% per month, but that's just for about 2 to 3 months in a year. During those times, we find the perfect market. This happens everywhere from time to time, when we can make 10 to 15 to 20% in a single month. So, in total, it turns out that the trading seems pretty average over the year. But thanks to those ideal months, we end up with a profit of 40 to 60% per year. That's basically how the Pareto principle works in financial markets. And this pattern, this screenshot from the service, you can check it yourself, has been confirmed since 2018. Actually, it's not even 2 to 3 to 4 months a year that are the most profitable. Let's take the Moscow exchange as an example. September 25, June 25, April 25, January 25, and then 7% in September 2026. The rest were either negative or had slightly smaller profits. In other words, just average results. It's the same on the American market. So it turns out that these, let's say, 3 to 4 months are what generate most of the profits. That means it's easier for everyone to make money during that time, not just you, but me as well. Even with experience and a lot of knowledge, even though this is my main line of work. So even with my experience, if I have a choice, I'll always go for easy money. There's a good saying about Russian people, specifically about the nationality, that a Russian is someone who loves to create insurmountable obstacles and then heroically overcome them. I didn't come up with this, historians did, but still. So why do that? If there's easy money to be made, if there's a market that offers it, I recommend you do the same. Why? Because a trend forgives mistakes, because a trend creates positive feedback when you get in and make money, because a trend gives you rapid capital growth, and trends are good for beginners. When the trend is favorable, you can earn a lot and do it consistently. So here are some practical recommendations. What should you do? Look for assets that are in a trending state. Don't try to catch the bottom. Just forget about that rule you read in textbooks, like sell high, buy at the bottom. Nonsense. Over time, I got used to the fact that there's a part of the market movement that I just never profit from. There's always some part where, while I was waiting for confirmation, waiting for an entry, some setup, or something else, I missed out. So, yeah, I just don't make money on that part. And when I stopped thinking about it, life got a lot easier for me. It didn't affect my profits at all. I still make pretty good money. But if you stop trying to catch the bottom, you'll stop ending up in situations like on the chart, where you get a second, third, or even fifth bottom as a gift, and you keep averaging down, losing even more. So stop wasting your time and money on that. Instead, just wait for a situation when the market bounces back and forms a consolidation in the form of some kind of triple bottom, a sideways movement. And from that state, from that breakout, in other words, from consolidation, from the breakout of consolidation, you start making your first trades. Look, here's what it looks like. The market dropped, bounced back the first time, but it didn't lead to anything. In other words, the consolidation led to further decline. The second time it bounced, there was consolidation. I entered on the breakout, and then, in fact, a reversal happened. The second time, I entered from accumulation, from consolidation, and made a profit again. Here's your first practical recommendation that you can use in the market. This isn't even about the tools, it's about the logic, the psychology, about how and where to look for positions. Friend, the second tip I want to give you is the 200 period moving average. It's a very simple tool. Here are the instructions on how to find it on the TradingView platform. If the price is above the 200 moving average, the market is in a long-term trend. If the price is below the 200 moving average, the market is weak and looking for another direction. That's it. It looks like this. With it, you'll be able to do an initial screening and get an idea of whether the asset is in a sideways range, an uptrend, or a downtrend. So your first conclusion should be in that direction. Look for movement if a trend is already developing. And now, the third tip. Use the trend as a window of opportunity. While the market is easy, learn and make money. When the market gets tough, don't be afraid to take a break. But if it's really easy, when the market is simple, go make money. This is the time when it makes sense to buy paid services and use ready-made information, because during this period, you can make enough to get you through the tough times. And when the market is tough, start learning, start developing, start adjusting your trading strategy, and begin earning on your own. When the market becomes easy again, you'll already be able to trade independently without a bunch of help. So, my friend, that wraps up the second lesson, and here are the takeaways. Quick money, no matter what anyone tells you, does exist. And I really love it. But it only shows up where there's a trend. And we can argue about this for a long time. Yes, I know how to trade in sideways markets. Yes, it's hard. Yeah, we can make some money in that phase. I even showed you the service's statistics. But damn, it's tough. And if I didn't have the service and it was just about my personal trading, I'd rather take a break. So if you've got a huge deposit and you've made money during a trending market, just go on vacation. That's it. And if you're doing something else and investing is just a way to have a second income or save up for something like retirement, an apartment, a car, and so on, then seriously, just take a break too. A trending market will let you earn steadily and well. The second thing we learned together, a beginner doesn't need to guess the market or try to beat it. We need to learn how to find ideal markets and switch when necessary. This is really important. Here's probably the dumbest answer I've ever heard. They went like this. I don't trade futures, so I won't trade metals either. Man, metals go up 15% a week. It's like 2025 over there. We're making in a month what we used to make in a year. We've had a couple of months with 15 to 20% gains, and he or she just refuses. But why? Come on, just Google it, find some information about futures. Let us help you. We'll give you the whole formula, explain everything. But we calculate the risk for every trade, and it's never more than 1%. So if you have a million, your loss per trade is only 10%. Some personal considerations led to the fact that the person waited for the trend to start on the Russian market, but it never did. And in the end, everyone made money while he just sat there waiting. So the idea is that at some point, an investor or trader basically becomes like a business owner, running from one supplier to another. Today it's the Russian market, tomorrow it's crypto, the day after that it's America, then it's currency. The currency market, forex, before its operations were considered fraudulent, but it lost its popularity. Or more precisely, by law, the central bank revoked everyone's licenses and the major players left. And brokers didn't really develop this area, so you can find it with almost any of them, but basically no one really advertises it. So what's the deal? The forex market also shows trending movements. The forex market lets you trade gold, platinum, or palladium at 3 a.m. when the Russian market is closed. So basically, if there's some movement in the Russian market, you can actually see it in your foreign account, which means you have the opportunity to trade calmly at any time. So this is the first step towards success. Work with the ideal market, work with trending conditions. That's the advice that brings me a lot of money. Let's put it that way. So now that you understand where the easy money is, let's move on to the most important skill. How do you calculate risk so that your deposit becomes indestructible? Here's a rhetorical question for you, though honestly, I'd love to hear your answer. How much money do you lose on each losing trade? And everyone has a different idea about this. Some people lose 5%, some 10%. Maybe it's an investment position and something drastic or even criminal happened in the market and they lost quite a large amount. It should be set up so that in every trade, whether it's a win or a loss, the amount is insignificant. That kills the emotions. So look, here's the logic. If my risk per trade is 1% and I have 1,000,000 rubles, a 10% risk per trade would be 10,000. If I have a profitable trade, let's say I make 1.5%, so the ratio is 1.5 to 1, or let's say 2 to 1, that would earn me 20,000 rubles. And let's say I had 50 losing trades. 50. 50 at 10,000 each. I lost 500,000. Just imagine, think about it, 50. So over a year and in a month, I trade about 30 to 40 trades, and that's considered active trading, so it's definitely not investing. In a year, I end up with, well, on average, probably 400 to 500 trades. Now imagine 150 trades. That means for 2 months, every single trade I make is a loss. I haven't met a single beginner. Statistically, by the law of probability, you'll guess right more often. So if you and I develop some kind of system, I'll show you one, that lets you limit your losses, then you really will make your deposit indestructible. And you honestly won't care at all what's happening in the global markets as long as you have your stop losses set in time. So just think about it. You have a stop loss in place and your risk is calculated. That's all you need to make sure you don't lose your money. After that, if you want, go ahead and practice. One channel, another channel, a third, wherever you get your signals from. And if you enjoy experimenting with your real deposit, go ahead. At least you won't blow it up. Your drawdown will always be manageable and you'll be able to recover from it. All right, let's go. Anti-drain? How do you calculate risk so that your deposit becomes indestructible? Before we move on to the calculation formulas, there's something you should understand. 95%. By the way, it's not just beginners. Traders and investors in general lose money in the market, not because they can't predict the direction, but because they choose. Their risk by eye. This is the only skill that determines whether you'll be able to build up over time or lose your deposit in the very first tough month. So let me say it again, okay? Well, imagine a situation where February 2022 comes around, the special military operation began, and the market started to crash. Everyone who didn't have stop losses got stuck. And then everyone was telling stories about how long it took them to recover. You wouldn't believe it, but even after 3 to 4 years, there are still investors who haven't broken even, who still haven't gotten back to zero. There are a lot of people like that. And why did they leave their trades open? And my main counterargument for them is simple. At that time, we had Abramenko open and we closed it at a loss. Yes, we lost money, our stop losses were triggered, we lost some, and in some cases, we had to close manually. We freed up our deposits, and the very next day, as the market kept falling, we shorted Aeroflot. We shorted other stocks, which made up for that drop. So in the end, in 2022, we made a profit just for that year. In 2023, another 100% gain. In 2024, another gain. And in 2025, another gain. So every year we still made money despite those kinds of market moves, simply because we had stop losses and we calculated our risk. So most beginners have one big misconception. They think the main thing is to find the entry point and then the market will take care of everything else. Well, remember, the story about the trend, but the market doesn't owe anyone anything. And in every trade, you'll get knocked out by a random move, some news or a correction. Right now, there is a ton of news out there. And if you don't have a clear risk management strategy, one trade can wipe out your monthly results. 2 trades can kill your entire deposit. You start to fear entering the market again. Your trading becomes chaotic. You fall into depression and apathy sets in. Basically, there's a whole long list I could keep going with. So, most beginners usually split their deposit into several parts when opening trades. They use equal amounts, like, say, 5% here, 5% there, and end up opening trades on 20 different instruments, or maybe 10 instruments, and they leave some of the cash aside on different time frames with different instruments. And that's not diversification. This has nothing to do with the saying, don't put all your eggs in one basket. It's just chaos. And I don't know why, but they don't talk about this in books. And the worst part is that most analysts keep promoting this nonsense, which honestly just doesn't work. The timing for executing trades, my friend, is always different. Real trading, in most cases, involves opening trades on different time frames. Today, we joined the dollar's rally and closed those trades within the day. We're still holding Sberbank positions for the seventh month now, waiting for a 30 to 40% increase from our entry price. Depending on market dynamics and whether there's a clear trend, we have to act on ideas or make do with what's available. For example, if the Russian market is flat, we have to look for trades on the 15-minute charts, either intraday or for a couple of days. But when a trend starts, we capture moves of 10, 20, even 30%. But these are completely different kinds of moves. And the higher the time frame, the greater the risk and the potential profit. When you diversify your deposit into parts, splitting it equally among stocks where the stop loss distance is larger, you're risking bigger amounts compared to a similar situation with intraday trading where volatility is usually just 1 to 3%. Remember March 2020? If you were trading then, think back. If not, let me tell you about it. Investors who were aiming for bigger targets had to accept the possibility that their assets could drop by 10, 20, or even 30% in value at any given moment. That is, when the market was just crashing. The investment approach to making trades is appealing mainly because it lets you respond to possible corrections and drawdowns as long as they're local, meaning just a little, like 5 to 10%. There's always the option to add more funds to your account and modernize your strategy. The only task is to identify a promising asset. Well, anyway, just so you know, we traders, people like me who are actively trading, we never look at the index results. Our goal, my personal goal, is to make something like 40%. In fact, I think the norm is 80 to 100%. 40% is bad. That's the lower threshold. If I hit that, I really feel like a total loser. Yeah, thankfully, we haven't had months or rather years like that. But investors compare themselves to the index. What do you do if the index ends the year in the red? Like I made zero, but the index is negative, so I call that an achievement? That's just nonsense. Inflation ate up your money and you just lost a whole year. So let's get back to the topic. If you need to enter a trade precisely, regardless of the time frame, and the amount of time spent on analysis, monitoring, management, and entries the same, then why limit yourself in the size of your trading positions? So my logic is simple. We trade absolutely everything we find, whether it's an intraday trade or an investment option. If they exist, we compare them within the same account, and there's absolutely nothing wrong with that for me. But they will have different volumes if we use the classic way of allocating money. I want to go through 5 practical examples with you so you can see firsthand all the drawbacks when you just split your account into equal parts for your trades. Let's set the conditions. We have a deposit of 1 million rubles. We divide it into 5 parts, and to make calculations easier, that's 200,000 for each stock. Let's go. I'll explain briefly, and if you need to, you can pause later and read everything you need. Let's take an example, trade on the 1-hour time frame. Here we found a triangle, which is a technical pattern, and we entered with 200,000, resulting in 9 lots. Our risk per trade is 2,000 rubles, and we can make 1,800. Don't pay attention to the supposedly bad profit to risk ratio here. This is just for example's sake. It's not a given whether you would have chosen this trade or not. So the profit to risk ratio is the criterion by which you should properly open a trade. In other words, it's not about how long the trade will last, but the profit to risk ratio. That's the only tool you should use to choose trades. That means you need to calculate it before opening a trade and its maximum value, meaning the planned value that can be achieved. Because look, if you can make as much from a trade as you could lose, then what's the point of that trade? If you can make less than you could lose, then what's the point of that trade? So that's the criterion. It's the so-called R factor, which we always use to evaluate all our trades, the ones I trade, post, and publish. Let's move on. The second trade. The second trade is the same triangle if you see, and here it's already on the 1 hour time frame, so it's exactly the same. We could lose 3, but we could make 4,900. So here the potential is already 1.6. In other words, our hypothetical trade is shaping up better. Notice that even though the time frame is identical, the potential risk and profit in the first and second examples are different. So these are already different trades. It seems like we found them on the same time frame, but the outcome is different. It turns out that in most cases, no one pays attention to this. But in a situation where the second trade closes at a loss and the first one at a profit, your profit to risk ratio, meaning 50% profitable trades, one profitable, one losing. But if the second one is a loss, you still end up in the red. And in reality, the market offers opportunities to work on different time frames. In one case, it's the hourly chart, a profitable idea. Well, for example, let's say the volume, take palladium, platinum, gold, silver. 3 assets generate more or less the same signal. You need to choose the one with the best ratio, because most likely they will be correlated with each other in some way and won't move in the same direction. And on the same time frame, trades can carry different risks, even if you enter with the same volume. So the third example, we open a trade from a triangle as well, but on the 15-minute time frame. We found it intraday. Here, you could lose 2,800 or make 4,900. Think about it, just like in the second example on the hourly time frame. But here, the trade will play out in just a day or two, so it will be almost twice as short. And it's important to understand that, yes, in some cases, even on the same time frame, we can find trades that play out faster. Or we can find a trade on another time frame, specifically on the 15-minute chart, that plays out with the same parameters and potential, but faster. This means you can turn over your deposit more quickly, increase your trading frequency, and earn more. The fourth example is also a triangle, but this time it's an investment option on the daily time frame. You could lose 27,000, but you could make 54,000. That's a 2-to-1 ratio. So look, the numbers speak for themselves. You could lose 27,000 or make 54,000, but in reality, that's a 2-to-1 ratio. It's almost the same as what we looked at before. And most importantly, this example shows that if you had investment positions in your portfolio, along with some speculative trades, very often the same money gets split between these positions. The speculative ones don't really bring you much value, either in terms of profit or loss, but the investment ones do. And if the market crashes, those couple of positions eat up your deposit so much that the others start to seem uninteresting to you. So if we compare, the fourth trade closes out a loss, it'll wipe out all your previous profitable trades that you made before. It turns out that only 25% of your trades are losing trades, but they ate up all your profit and you ended up owing even more. I hope you're starting to notice the logical chain here. Fifth example. This is a weekly time frame, and here we're looking at the implementation for a full calendar year. You can lose 61,000 rubles per trade, but you can make 170,000. The ratio is 2.78. Looks like a real treat. You can make 170,000 on a million. That's an immediate 17%. But if it closes at a loss, you'll lose. And not even 1 or 4 of the previous trades together will make up for it. So far, we've looked at 5 examples. And if the last one results in a loss, it will bring your entire deposit down by 6%. And not a single trade in the series, taken individually, can cover the loss incurred in this trade. And carefully review the series of trades again if you need to. Then add a few more facts about the market. We never know in advance which particular trade will turn out to be a losing one. And political and economic events in the Russian market illustrate this situation very well. Those people who held onto their investments for a long time could suddenly lose their profits all at once. And as a result, yes, their favorite trade led to a very, very significant drawdown. So if this particular trade, the last and largest investment, turns out to be a loss, the share of profitable trades will be 75%, just like I told you, but the actual profit, even if all the others close in the black, will be only 3% of the deposit. That's the whole math, which many people don't even bother to calculate. Let's get back to the ER indicator. It's an important metric that in most cases people don't even pay attention to, yet it's a key element in determining the effectiveness of a trade. Regardless of the time frame, trades can have the same indicator value, which means the trading idea is equally significant for your account. And if the indicator is the same, then it's definitely better to prioritize high turnover, meaning you should switch to a lower time frame and execute the trade. This way, you'll be able to make more trades in the same period of time, which means you'll earn more. A risky trade. A single executed trade with significant risk is a double reason for periodically losing your initial capital or drawing down your entire deposit. Think about it, 5 examples, and here it's shown on the chart what that looks like. And basically, we come to the point, well, profit, of course, is also different, right? We tend to overestimate, let's say, our expectations, the results we can achieve, our desire to get more. But in reality, just one failed trade like that is enough to start reducing our deposits, and we end up with unlimited losses. So, why is all this happening? Something needs to change. We need a system that allows us to eliminate all these risks and bring order to our trading. If you need to, watch it again. If you need to, you have the recording at any time, so you can really understand the whole problem with using this diversification that everyone writes about in books. Now it's time for my own theory, the fixed risk algorithm, which I've been using for more than 10 years. So, fixed risk, this method involves first determining the amount or percentage of your deposit that you're willing to lose if things don't go as planned. In other words, we always start with the understanding that in any trade we open, we could lose money. That's normal. It's just part of the process. Trading is like a business. You have revenue, which is your profit, and you have losses, which are your losing trades. Only the balance or the difference between these two figures is our final profit. So if you have a deposit of 1 million rubles, we would decide that our risk per trade is 10,000. So a fixed risk means you always know the amount of risk for each individual trade. It becomes static. We determine the total risk for all open trades within a few seconds. However many trades you have open, you multiply by the fixed risk, and that's your total risk across the whole deposit. If I have 10 trades open, each with a 1% risk, then my current risk is 10%. Set the risk so that a single trade or a loss in a day can't wipe out the earlier profits you've made. This isn't possible with fixed risk. It also allows you to have a method in your toolkit that lets you equalize the importance of short trades on lower time frames and longer trades on higher time frames in terms of risk and potential profit. In other words, it doesn't matter to us what time frame we're trading on. What matters is that the trade has good profit potential and that we can make money from it. Fixed risk is an opportunity to make money even when the proportion of profitable trades is equal, or even if there are fewer profitable trades. That's actually a fact. And we evaluate the potential of planned trades using the R metric, choosing only those that have more potential in terms of the setup, not just the amount of money or volume we're allocating to them. Let's move on to practice and see what this looks like. To use fixed risk, we need to meet the following conditions. Determine the risk size per trade. When opening a trade, always use a stop, because you'll need it anyway for the calculation formula. Filter trades and select only those with potentially high ratios. Calculate the trade size based on the risk amount, not diversification. This is important. So the size of our position will be equal to the risk amount divided by the risk per share. Example. Imagine a stock priced at 100 rubles with a stop level at 90. We set our profit target at 120. Our risk per trade is 10,000 rubles. And in fact, for all the examples we've looked at, we'll calculate it the same way. So our position size comes out to 10,000. Minus the difference between 190, which is the entry price, and the stop, we get 1,000 shares. 1,000 shares multiplied by 100 rubles gives us 100,000 rubles. So we always calculate a fixed risk, but the position size can vary depending on the time frame we're working with. It's the size of the risk that determines the size of our trade. As you can see from the example, regardless of the time frame, we can make any trade more or less risky for us relative to our deposit. It's important to note that the smaller the time frame and the closer the stop, the larger the position size will be to realize its potential. When using a fixed risk, a single trade can take up to 100%. It's important, and if necessary, we also use borrowed funds, which, by the way, does not increase our risk. So even if you and I enter a trade with 100% of our deposit or go all in, since we're only risking 10,000 rubles out of a million, nothing changes. For example, if we have 6 trades open, each with a risk of 10,000 rubles, that means we have a total risk of 60,000 rubles at that moment. So now let's look at those same 5 trades, but this time from the perspective of fixed risk. In other words, we found a trade on a certain time frame and we calculated it together. So we end up with a position size at 10,000 rubles divided by 210, the distance to the stop, entry minus stop, so we get 47 shares or 958,000 rubles. That means we're putting almost our entire deposit into this trade, but our risk is 9,900 and our potential profit is 9,500. So look, the profit to risk ratio hasn't changed, just the numbers have. The risk for this trade. We intentionally increased the position size in order to bring our risk up to 20,000. In the second example, using the same calculations, we get a trade size of 640,000. The risk for the trade is 9,900 and the potential profit is 15,800. Let's keep going. The third trade, remember the one that was a bit bigger? Oh wait, there was still the 15-minute one. 10,000 rubles at risk, 17,700 potential profit, and the last 2 were investment trades. We intentionally reduced the risk on those, meaning we decreased the position size so that our risk per trade is 10,000. The potential profit for the trade is 20,000. And the last trade, 10,000 at risk and 27,700 potential profit. Now take a look at the difference between diversification and fixed risk. From the chart shown, you can see the results of using fixed risk, where we achieve stable and controlled risk for each trade. Let me put it simply, it doesn't matter to you anymore which trade ends up in profit or loss. Of course, the one with a higher profit to risk ratio is more profitable, but in reality, no matter which one closes at a loss, the other will pull you back into profit. The only significant parameter left for determining which trades we take is the profit to risk ratio. This encourages us to look for trades with a potential greater than 1 so that any profitable trade can cover your losing ones. As a result, having a fixed risk allows you not to be afraid of too large a stop, to trade on any time frame, to choose only quality trades, and to survive even during tough periods. If you hit a rough patch, you just lower your risk to 0.5%, 0.2%, and keep living your best life. If you need to test out a strategy or an analyst, you just lower your risks, and you'll make it through absolutely any period. So, my friend, this is the proprietary system I've been using for many years, and it's saved more than one account. In the end, we calculate the risk amount based on the balance after closed trades without taking into account floating profits or paper losses. This is exactly how we determine, in monetary terms, from which amount to calculate. In the examples with stocks given earlier, the value of a point is calculated logically and was set equal to 1 ruble. A price change of 1 ruble equals 1 ruble for this account. If you work with the derivatives market, with futures, the value of a point may differ from the classic understanding. So, for example, 1 point of price change might be worth 1.3 to 1.6 in RTS, or say in oil or metals. You can always find the latest data on the exchange's website or ask your broker. If you decide to change your risk level per trade, the process should be quick and apply to all positions. In other words, you can't have one trade with a risk of 0.5 or 1. If you do that, you're going back to the oldest approach. In that case, close all trades and start working with the new parameters. And keep in mind that if changes are made during a drawdown, it will take longer to return to your original amount. So if you entered a drawdown with a 2% risk and then decided to switch to 1%, it'll take you twice as long to recover. This is a really important point. It's better to choose the right risk in advance, not during a drawdown. And, well, probably one of the best pieces of news. If you thought this was complicated, everything has already been done for you. Here's a risk calculator on my website. It includes futures, the Russian market, the American market, and, of course, cryptocurrencies. You just go in, select the instrument, enter the parameters, entry point, stop, profit, and it gives you the position size for the risk you set in the calculator beforehand. It's free, has been for probably 9 or 10 years now, and it will always be free. So this is my contribution to the community of investors and traders, so that, my friend, we make fewer mistakes and lose less money. So if you need to calculate risks, please go ahead and use it. I don't mind. The main thing is that it helps you. If you learn how to calculate risk, you'll already be ahead of 90% of investors who are still just sitting and waiting for their deposits to recover. That's a fact. We're wrapping up the third part with you. And here, we figured out how to protect your deposit in any market situation, how to choose the trade size using fixed risk, and how to make sure a series of losing trades doesn't hurt you. And how, with the same trading skills, you can earn 3 times more. If you didn't get the fourth point, I'll repeat it again. If you have the same profit ratio between trades on the higher time frame or the lower one, choose the lower time frame because your turnover will be higher, and that'll allow you to make more trades than on the higher time frame. It's simple math, even statistics, and it always works. Now we're moving on to the fourth part. This is an important part. The technique of precise entry, using DRAM correctly. How does a professional do it? How do I do it? How do I teach this to my clients? This is probably a treasure trove of experience, but it's better to get it right from the start. So listen carefully, and if you need to, pause the video and come back later when you've poured yourself another cup of tea. But don't stop, watch the video until the end because I'll keep giving you the same kind of valuable content in the same style. So typically, beginners lose money where they shouldn't on technical mistakes. The reason is simple. They don't know how to use their broker's orders correctly. You might not believe it, but about 60 to 70% of my clients who join the support service, where I provide trades and analytics, don't know how to use orders. They don't know how to enter with the limit order. Basically, everyone only knows the buy at market and close at market buttons. And as a result, if someone has a large deposit, they can get tossed around pretty badly on the second or third tier and end up losing money for no good reason. That's why it's better to learn this from the very beginning. Choosing the wrong type of order can lead to slippage, meaning when you request one price, but you get filled at a different one in the market. It can lead to buying at a worse price than expected or missing an entry, meaning your limit order doesn't get filled, your stops are set incorrectly, positions get closed by accident, and you end up with losses. And these are losses that have nothing to do with analysis or the game itself. In other words, just think back to the very beginning when we first started our conversation. It's not the analyst's fault. You just used the wrong order and ended up with unnecessary losses that could have been avoided. Let's avoid those losses right now. So, theory. We'll look at the specifics of different order types and how to set them correctly, using one broker as an example to study the math behind the process. In practice, after this video, you'll get ready-made instructions tailored to your specific broker. That is, you'll choose which broker you use so you don't make mistakes, and you'll be able to set everything up according to those instructions. This is absolutely free for you. It's my bonus to help you grow. So an order is your instruction to the broker to buy or sell an asset under certain conditions. The way you manage orders directly affects your profits and risks. There are 4 types of orders. Market. This is an order executed immediately at the current price. Limit. A limit order is executed at the specified price or better. Stop or conditional, meaning a stop order or a conditional order, is triggered when certain conditions are met, most often when a certain level is reached. And combined orders like OCO, trailing stops, take profits, and so on and so forth. When you set both a stop and a take profit in advance, right after entering a trade, risk comes first, then profit. The trade size is a function of risk, not greed. Automate this routine. If you can set it up in advance, make sure you do it. Don't trade manually without a good reason. That's a direct path to chaos. In other words, don't use market orders. Start with minimal risk, 0.5 to 1% per trade, and only with limit or conditional orders. This will build your discipline. Don't know how to calculate it? Use a calculator. I already shared the link. If you need it, just rewind a bit. A market order, my friend, is an order that gets executed immediately. Next, we have the broker's fee. You get speed, but you lose control over the price. Bros, execution is instant, which is convenient during sharp moves, breakouts, or emergency exits. For example, if the market is crashing, you need to get out somehow. Okay, I'll allow it. You can use that. Pals. Slippage, your entry is worse than expected, your exit is worse than expected, you lose control over the price, meaning you don't know at what price you'll end up closing, and with low liquidity, it often leads to pretty big losses. You should only use it during high volatility and with a small deposit size. So if your deposit is 100, 200, or 300,000 rubles, well, okay, fine. You won't have any major problems. Millions or more? Think carefully. Don't use market orders. You can also use it for an instant exit from a position if there's a risk of a crash. During news-driven moves, when speed matters more than price. That's also an option. Check the liquidity before you hit the button. That is, there needs to be enough volume in the order book to cover your order. For example, let's say you want to buy 10 lots, but there are only 1 or 2 in the order book. You already know you'll get slipped until you clear out the whole order book. This is especially important, for example, if you're trading bonds. There, basically, executing a trade for a specific amount is a big problem. You have to enter in parts. To enter a trend, use a market order for a smaller amount and place the rest with a limit order. So you enter with part of your order and then add the rest with a limit order. If you're ready to enter at market price, use a limit order. So you deliberately switch from a market order to a limit order and set the price just a bit worse than the market price. That way you set a ceiling, for example. Yes, in the end, you almost get the same result as a market order, but if there isn't enough volume or something else happens, you'll have a cap and you won't end up entering the market beyond that point. And really, a market order only saves you in a panic situation. It gets expensive for planned entries and exits. Limit order, it lets you buy cheaper or sell higher than the current price. In other words, you set the terms for the market under which you're willing to enter or exit. Pros, control over the price. No slippage, meaning you set a limit beyond which the trade won't happen. And you can set it in advance and calmly wait for your level. Cons. It doesn't always get filled. The price might not reach your level. During strong moves, your order might be filled only partially. In other words, if the price shoots past, only as much as possible will be executed. We use limit orders when entering on a pullback to a level, meaning when the price returns to a certain mark, for taking profit, or for pre-planning a trade. As a tip, always place your limit order in the likely touch zone, not at some dream level. Don't put it right at the edge, at the very top where you hope the price will go. No, just in the zone, in the middle, so it's more likely to get filled. I combine limit orders with conditional orders to trade both breakouts and pullbacks. Often, limit orders can be completely replaced by conditional orders. And in my case, if we're talking about the final setup, I actually always use only conditional orders, placing just one order, like the one you see on the slide right now. A stop order is triggered when the price reaches the specified level. For breakouts, but again, just to repeat, it can be conditional, right? This is your automatic protection. Even if you're offline, even if your internet is down or blocked, everything will still work as intended. With some brokers, a conditional order is placed in a separate category. It can be either a limit order or a stop order, so you can classify them into 2 types, for example. With Finim, you have the option to check Set Stop and separately Set Profit. This will be a single order that will appear in your order list. That's it. Types of stops. These can be stop market orders, which turn into regular market orders when triggered, and stop limit orders, which trigger but set a limit within your specified range. In our service, we use ranges. Here's how it works. So for example, if I want to buy at 100, I set a stop order and I set the range, let's say up to 102. This means that I buy only within the range from 100 to 102. If the price suddenly jumps past that range, meaning there's slippage, I'm not in the market. So in this case, the risk to reward ratio is lost. And my original plan, the one I wanted, doesn't look as attractive as I hoped. So I'm basically ready to walk away from such a trade. So the advantages: it protects you from major losses, allows you to enter on a breakout and exit according to your plan. Disadvantages: there's a chance the price could skip your order if you use a stop limit. Like I mentioned in the example, right? The price just shot past. If there's a gap, the stop might be executed at a worse price than planned if you use a stop market. In other words, the position starts closing at market price, and then everything just unravels from there. You need to set your stop. It has to be set correctly, and it should follow the market logic. That is, based on a specific model, setup, or pattern calculated at a specific level. Not just -2%, not -5%, not just somewhere random. It must always be set at a predetermined, well calculated level. Always take volatility into account. The ATR indicator helps determine volatility, and if the value is very high, then a tight stop will almost always get taken out by the market. If the asset is volatile, set a wider stop and reduce your position size. This is advice for absolutely everyone. In other words, it's better to use a wider range but stay in the market with your open position. Accordingly, there's another parameter that unfortunately isn't available with every broker, but it's really, really cool. We know that the Russian market has liquidity issues. There are spikes, whipsaws, gaps in both directions, and sometimes just one quick move or even a second can determine the outcome of a trade. You can set a time-based parameter. Well, first, let's talk about the offset. Offset. Set the difference between the trigger price and the limit. That's what I was telling you about. We set it at 100. The limit is 102. And so accordingly, we don't go beyond that range. And you put the average spread in there. That is the average level of volatility currently in the market. When liquidity is low, we increase the offset. For large futures contracts, you can use minimal values to ensure you get the exact price. Here's a really good tip I want to give you. A lot of brokers take advantage of this. If you set a wide range of big spread, they'll open your order at the upper limit. So if you place a market order, you'll always get filled at a bad price. If you set a spread, they'll fill you at the upper boundary. When you start narrowing the spread, you get into the market, but at a lower, more favorable price. This is a little secret. I'm not sure why, but for the past 3 or 4 years, this is exactly how it's worked. It's the same with all brokers. There's nothing specific here. So, in my opinion, if you need to, pause the video and make sure to write this down. The move plus the size of the offset is the entry limit. Where is the size of the offset equal to? I take the entry price, subtract the other price from it so that the value is positive, then multiply by 10%. And basically, that's the size of the offset. If we're talking about the stop, then the size of the offset is calculated as follows: entry price minus stop multiplied by 25%. So in the case of a stop, I'm willing to close 25% worse, but I'll definitely close. That is, so I don't end up holding on too long or waiting out the loss. Protective time is also a really cool thing, but it's not available everywhere. It's the period of time after the trigger is activated when the order becomes a request. So the condition you set has just happened. Let's say, for example, you want to close the stock at 90. You bought at 100, your sell is at 110 or 120, and your stop is at 90 or 100. And then you set the protective time, let's say 10 seconds, at 90. First, it'll hit 90, then there will be a 10-second delay, and only after that will it execute. And from my experience on the Russian market, all the spikes that formed, the very ones with a breakout in either direction, believe it or not, they all lasted up to 20 seconds. So by setting a protective time at 25 seconds, in 99% of cases, I avoid the risk of closing a trade at a real bad price. Which means that if for some reason you suddenly decide to go without a stop loss, you still have time to close the position manually. In other words, it would be a real disaster if you were caught off guard. So, if you're using Finale, make sure to use the protective time. And, my friend, at this point, an hour and 40 minutes have passed. Yeah, we've basically just sat through a regular college lecture together. I've explained the theory to you. At the end of this video, I'll tell you how to get a ready-made instruction manual for your broker in case you need to download it. I hope you still have some energy left because we have one final step to complete, and we absolutely need to do it right now to put a bold period on our work together. So I've summed it all up and shared the important part with you. Not just how to protect yourself from, let's say, unexpected events, but also how to create a roadmap. Here's what we know so far. Where do you look for the best deals? What is the ideal market and how do you find it? So I'll give you a moving average. I showed you the formula and the algorithm for calculating risks. I showed you how to technically enter and exit, how to use orders correctly, and also add some more instructions. I've given you the calculator. Now, the most important part remains. You need to create a roadmap for the next 90 days if you plan to work on your own, so you can move forward correctly and not go in circles like most investors do. And here is part number 5, how to get out of chaos and start earning systematic. I'll be showing the roadmap for the next 60 days using my own example. Basically, the goal of this section is to create a clear system of actions, concrete steps, and to honestly understand at which stage you need support. In other words, so you know when to take a pause and where to look for additional help. Sometimes it's in books, sometimes online, sometimes you need to look for a mentor specifically, but the point is to keep it transparent so you don't end up stuck in one place and losing your money. For each stage, I'll show you the tasks you just need to complete to get results. That's it. I tried to make it as simple as possible. First, risks. So now we're going to go through that very system I showed you right at the very beginning. Just because the system is clear doesn't mean it's been implemented. At this point, you have a ready-made algorithm for calculating risk, position size, and monitoring all your trade metrics, but knowing the system isn't the same as being able to use it. Most investors lose money not because they lack knowledge, but because of mistakes in applying it and a lack of feedback. First, risks. So use the calculator and you'll be happy. The second stage is analysis and making the trade. What to buy, at what price, where to cancel, where to exit. The stages related to trades need to be divided into two groups. The first thing to buy is, above all, market analysis and filtering for promising assets. Here, the market itself is ideal. Second, at what price, where to cancel, where to exit. This directly concerns the trading algorithm, or more simply, the setup, which you can look up on the internet. And as an example, I'll show you something. So, market analysis, fundamental analysis. As I told you, this isn't my specialty. It's not my area. I don't deny its importance. I just use my own philosophy. So, fundamental analysis can help answer the question of what to buy. It evaluates the economy, reports, rates, inflation, news, and expectations. It helps you understand the overall interest in an asset, but it doesn't give you precise entry and exit points. Remember how it's written in the books. Every month, put some money into your account, buy a little bit at a time. That's basically all the fundamental analysis that's promoted in our country. So there will never be any entry or exit points there. So if you know a bit about fundamental analysis, by all means use it. It'll help you figure things out and get extra information. But I'm all about technical analysis. Technical analysis answers the question of when and where to enter. It works with price, movement structure, volumes, and the behavior of market participants. In other words, the result of their collective psychology. This is where precision comes in. So you enter at this level, exit at that level, and lock in profits right there. So if we compare fundamental analysis to technical analysis, fundamental analysis often lags behind and changes after the price has already moved. For example, the forecasts were one thing, then sanctions were imposed and the forecast changed. A company might say everything is great. Let's say, for example, an aircraft construction company. But then it announces to the whole country that it needs government support because it can't handle its loans. But did no one know about this before? It turns out, no, the market didn't know. So the market can stay cheap for years, despite fundamental analysis claiming a fair price. An asset can be considered promising for many, many years, a long time. For example, probably this one. VTB, which has remained undervalued for more than a decade and still is to this day. Some fundamentalists even estimate that its market capitalization is lower than the actual value of its assets. But nevertheless, that doesn't stop it from staying cheap. And when it comes to good news, it often comes out at the peaks. In other words, the price always reacts before all these reports and headlines because there's always an insider factor. That is, there's extra information that we don't know about. As for technical analysis, it shows the real behavior of money and allows you to determine the stage of the cycle. For example, here's my example on the chart. How do I do this? It gives specific entry and exit levels and lets you manage risk in advance. Because the price takes into account investors' expectations, news, fundamental news that has come out, events, emotions, and liquidity. All of this together is already reflected on the chart as a result. Accordingly, fundamentals can suggest ideas, but technical analysis provides the solution. That's exactly why in systematic trading, technical analysis is personally my foundation. Fundamentals are just an additional factor. I don't mind reading the news, making a note in my calendar about X dividend dates, what dividends will be paid, basically where investors are likely to move. Someone might look for trades in this asset, but I'll look for 'em my own way, using technical analysis. And that always works better. Moving on to the third stage, when we're talking about a specific trade, here's an example for you: the triangle pattern. In other words, a ready made algorithm that I use. This is what it looks like from a technical analysis perspective. We find any existing pattern it's already formed. If you want, find it in a book, on the internet, or check out my YouTube channel. There, you'll find Andrews and Schiff's pitchforks, which I explain in quite a bit of detail. Define the entry conditions and write them down for yourself. Write down the rules for pattern formation, the conditions for filtering out false signals, in other words, what to discard, what to keep, and how to trade, and the rules for managing the trade, what to do after you exit. As a result, you'll have a draft of a setup that we'll use to build our trading strategy. And now, this is important. Look, after we've put together the algorithm, we need to test it for suitability and effectiveness in the market. We'll need to gather some statistics: the average profitable trade, the maximum drawdown, and the frequency of occurrence. An important point: what is maximum drawdown? If at some point in trading I end up with a streak of 5 losing trades, my personal record over 15 years, I think, was 8 losing trades in a row. Man, can you imagine? That's really how it turned out. And what did that mean for me? I analyzed everything, looked it over, and over all that time, I found 3 situations where I had between 6 and 8 losing trades in a row. So, to put it simply, it's a feature of my system that at times I can end up with this kind of result. As a result, I reduced my risk from 2% to 1%, and now the maximum drawdown I can get is 8%. That's it, I'm satisfied. But not knowing your maximum drawdown can put you in an unpleasant situation, even depression, where you'll feel like your system doesn't work. You won't understand this until you have statistics and realize that it's just a certain number. So, for example, someone has 3 losing trades in a row. It's like roulette, red or black. How many times in a row can the same color come up? It's just statistics, and you need to collect that data. So, the final stage of the process, which is related to independent trading, looks like this. Basically, these steps are necessary to gather the right statistical information. I'll use Trade and Wheel as an example. There's a simulation feature there. We cover up the right side of the chart, basically hiding it. Then you hit play, and the chart starts scrolling forward. You find a setup you need, describe it, set all the parameters, and record it in your notebook. You run the simulation, find at least 50 to 100 trades, and eliminate all mistakes. Like here you entered wrong, here something didn't work out, just toss those out. Keep only what was done according to the algorithm and the system, and identify the weak spots. Then you start looking for ways to modify it. Here, you run through another 50 to 100 trades. So after running several cycles, I arrived at the final numbers. For example, I trade 100 deals, and after those 100 trades, my average profit per trade is 0.23, and I make 20% over those 100 trades. The proportion of losing streaks, meaning the maximum drawdown, is say 7% or 5%. You get the statistics, and then you start comparing: do you like them or not? If you like them, you keep working. If you don't like them, you run another cycle. And after that, you take your algorithm to the real market. That's it. That's the whole secret you need to know. So, simulation is there to help you quickly understand how your system works without risking real money. You need to use it. Abroad, this is called paper trading, which basically means paper trading. And why do you need this? If, for example, you're an investor who only makes 50 trades a year, just imagine you need to gather statistics for 50 to 100 trades. Then the results of your experiment will only be available in 2 years. That won't work, so what do you do this year? That's why market simulation lets you do it quickly. So, as part of my training program, my clients have an assignment to run 100 trades in a simulator as an initial stage. They usually do this in about a week. So, a week is more than enough for you. All right, let's say you take 1 to 2 weeks. But simulation isn't just demo for the sake of demo, it's a stage for testing your strategy before using real money. If the strategy doesn't hold up, you look for the next one. In other words, to put it simply, if we take a step back, you just throw that one out and look for another. You look for another analyst, another strategy, a third book. And this way, if you've set a goal to achieve results on your own, you will get there. But you'll have to do all of this. Remember how I said at the beginning there's no other way? In other words, this is the only way possible. What does simulation look like in TradingView? We go into the service. By the way, the name is on the slide, the icon is there, you'll get it. In the top menu, select the simulation icon as shown, and then at the bottom, you control everything using the control panel. What should you record during testing? What do we need to reflect in our trader or investor diary in our journal? During testing, it's important to record not just the result, but also the context. That is the date, the market, what we're trading, the time frame, the session, and when. The setup. What rules did we use to enter? Was it according to the system or not? An important point, why did you enter? Next, the entry point, record the actual values, the risk size, how you calculated it, how you entered, the market context, in other words, where you are in a trend or in a sideways market. This way, for example, you can find out how effective your setup or system is in a trending market versus a sideways market. If it doesn't work in a sideways market, what conclusion do you draw? Either look for a new strategy within your system or just don't trade in a sideways market. That's also a decision, and you need to know it in advance, too. Ways to manage the trade. Who used which tool, which approach? The result of the trade, comments, and any additional notes if there were any. So, unlike Bryukhav's report, the goal of the journal isn't just to record numbers when you entered or to prove whether you were right or wrong. It's to find the weak spots. And in the end, if you do all this, you'll have a complete cycle. And you'll come back to this system, which I've been using for the last 15 years. If you go through all these stages, you won't just start trading independently, you'll achieve results. Risk calculation, figuring out what to buy, at what price, where to set cancellations, where to exit, where the mistakes are, and what to change. And this cycle, this system becomes a closed loop that you repeat year after year and keep developing. So there's life before investing and after. On average, going through one of these cycles will take someone 60 days, for others, 90 days. So, yes, if you really commit to 60 days of practice, that will be enough for you. And it's exactly during the process, in practice, not in theory, that the main question comes up. What was done right, and are you applying it correctly? So, right here, my friend, when you start working with the market on your own, you might feel the need for a mentor or advice on how to properly use a specific tool or element of your system. At this stage, most people run into the same situations. The market changes, you're not sure if the setup is still relevant, there's a scenario, but you're afraid to enter, and as soon as you do, doubt creeps in. Maybe the stop seems too big or too small. After the trade, it's unclear whether it was a mistake or just part of the statistics and whether you should lock in the profit. That's normal. It's not a knowledge problem, it's a challenge of walking your own path, which you'll have to face. If we sum things up, we're smoothly heading toward the finish line. If you haven't realized it yet, this mini course you've watched in just 2 hours gives you the logic and structure. It shows you how professionals think, how we've been working for a long time. Not something we invented, but something we follow. How to help you avoid critical mistakes that are related to money. But unfortunately, this course can't check your trades, look at your journal, or adjust your logic to the current market. If you watch this video right now, or in 6 months, or even 5 years from now, this video will still be here, but it won't be able to support you in real time. And this is where a gap arises that you might encounter. In real trading, the key element becomes not knowing the environment in which you're applying your system. The environment, the team, the community, whatever you want to call that place where you can ask questions, compare your perspective with a mentor. Let's not use the word professional, with a mentor. To see the market through the eyes of an experienced participant and analyze mistakes before you enter a trade, that is, before those mistakes cost you money. Looking at the slide presented here, you can see exactly how this entire process works for our team, how participants engage by asking detailed questions, and how, through this very interaction, they develop their professional skills and successfully earn a significant income. And if after this course, after these 2 hours we spent together, you feel like you understand something, you've grasped the logic, but you still have doubts or you're not sure how to apply it, if you want to see how it works in the real market, and you realize that trading alone is harder, especially when it comes to learning on your own, I invite you to take the next step: a free trading workshop. This is a place where you'll have the opportunity to see how analysis is done in real time as I guide you and show you how we find promising assets and identify setups. You'll understand how to manage trades in different market phases because it really does vary. You'll be able to ask questions in real time about your decisions and situations, that is, about the materials you're currently working with. You'll be surrounded by people who are on the same path as you. Just so you understand, this isn't a training course. We're not going to pretend or promise magic and say that you'll get absolutely everything for free. No. This is a place, a team environment where we work together, where I demonstrate, where I show things. This is not a training course. I'm not going to give you ready made tools. This is a place where you can actually see for yourself that all of this works. It's a transition from understanding to practice. But this is a free space where, over 60 days, we put this roadmap into action through your own efforts with real, concrete examples and feedback, so you can truly understand all the material we've provided. You'll figure out the risks, find the ideal markets, and learn how to open orders correctly. You'll be able to correctly read market situations and understand how to build your own strategy for entering trades, managing them, and make it a profit. So, at this point, as I wrap up my monologue in this video, I want to tell you the main thing. You can keep working on your own, and that's totally fine. Maybe you didn't even watch this video all the way to the end. That's also okay. It just means you're not quite ready yet. But you can make your journey easier, faster, and less stressful by joining the free trading workshop. The link will be sent to you after this video through the bot. You'll get it separately so you can receive instructions for your broker. You'll have the opportunity to get access to VTB, FINA, BKS, and Alpha. And there will be a link to the free workshop. No one is forcing you. If you want, come join. But inside, I'll show you in practice how all of this works. This was Dmitry Abramenko with you. My friend, I'm 200% sure that no one has ever given you this much useful information, real substance, with concrete advice, step by step algorithms and instructions, stuff that's usually hidden behind a paywall. And I hope that, even just a little, I will definitely help improve your trading for the better. And if you're ready, I'll be waiting for you at the free workshop. There, together, we'll definitely earn your first profit.